things are really, really expensive. Now, can they get more expensive? Yeah, but they're about as expensive as I've ever seen them. I've never seen, for example, a CAPE ratio at 40 and current earnings at 24 and a half. I mean, everything is really off the charts. So could it get higher? Yeah, it could. It might, but I think you have to think about this as saying that, I'm at least in the 8th or 9th inning. And when you think about it like that, maybe it makes you stop and think a little bit.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Short of a dramatic surprise in the next few weeks, the markets should end 2025 with another big double-digit positive return for the 3rd year in a row. A string of three-peats like this is quite rare in the markets, which raises the question, can the momentum last in 2026? Or will the market's return start to mean revert? To discuss, we've got the good fortune of welcoming back to the program high net worth financial advisor Ted Oakley, managing partner and founder of Oxbow Advisors. Ted, thanks so much for joining us today.
Good to see you, Adam.
Ted, it's always such a pleasure to have you on here. I'm very much looking forward to this discussion. It's been too long since we've had you on last. A couple quick housekeeping things before we get to the meat of the discussion here. One, this is the first interview that I've recorded since I broke a tooth this past weekend and had to have an emergency tooth extraction, which was not fun. I'm doing fine now. But I will admit, I'm very self-conscious about this gap that has been left, and I'm going to get a replacement tooth for it, but it's going to take like over half a year. It's crazy how long apparently this takes. So anyways, I am more than a bit self-conscious about this. Hopefully folks won't see it while we're talking here, although eagle-eyed people might be able to find out exactly which tooth is missing, but I'm not going to share which one. But anyways, if I seem a little out of sorts, it's because I'm trying to figure out how to talk without showing the gap.
Well, I haven't noticed anything. If you hadn't said anything, I would never know.
Okay, well, that's good to know. And just to make it clear for folks, it wasn't like tooth decay or anything like that. I literally just broke the tooth, and they said, look, your teeth were really healthy, which was what made the extraction so hard. Because the rest just didn't want to come out. But anyways, thank you for that. Also, we'll talk more about this at the end of today's discussion, Ted. But you and the Oxbow team will be doing a free webinar for the Thoughtful Money audience next week on succession. Basically, if you are the one who is managing all the finances and the investing for your family, that's fantastic. But what happens if you can't be there anymore? Either you get incapacitated, you pass away, whatever, you decide just to give up the reins. It's something that a lot of this channel's viewers who are DIY investors wrestle with. They don't necessarily have a family member that they can hand that responsibility to. And so the question is okay, well, what do you do in those cases? So this is a topic of which you are very well experienced at Oxbow. And I believe we're going to be doing this webinar, I believe it's this coming Monday. That's December 15th, and we're doing it at 7 p.m. Eastern, correct?
Correct, right.
All right, and folks, if you're interested in attending, it's a free webinar. You can go sign up for it at thoughtfulmoney.com/succession. And again, folks, we'll talk a little bit more about that at the end of this discussion. But at this point, Ted, let's just roll up our sleeves and dive in. So I mentioned in the intro there, we've had 3 really robust back-to-back years of double-digit returns for the stock market. Is it likely that can continue into 2026, especially given whatever your outlook for the markets is? And maybe why don't we start there? What is your outlook for the economy and the markets right now as we head into the next year?
Well, Adam, it looks like, we'll be a little bit slower because, obviously, employment slowing down. That's one of the things that drives it, which probably, we may not notice it in the numbers here. We usually don't during Christmas and that period because people, for some reason, they dig down deep to make it happen. But next year, you're probably going to have lower employment. And when that happens, it'll have some impact on the marketplace. It wouldn't surprise me since we're ending the year like this, to have this roll on into the first quarter and be a pretty good quarter. I do think there's a spot in 26 where you hit a more significant high, probably, and then you have a bit more of a setback. But that could be second or third quarter. I don't know. But, things are really, really expensive. Now, can they get more expensive? Yeah. But they're about as expensive as I've ever seen them. I've never seen, for example, a CAPE ratio at 40 and current earnings at 24 and a half. I mean, everything is really off the charts. So could it get higher? Yeah, it could. It might. But I think you have to think about this as saying that, I'm at least in the eighth or ninth inning. And when you think about it like that, maybe it makes you stop and think a little bit.
All right, eighth or ninth inning. Okay, so that's got to make you feel like at some point, I'm guessing in 2026, you get to the end of the ball game. And as you mentioned, I think you said, yeah, maybe it could get a bit higher for a while, but then you expect it to have some sort of correction. I've talked with you long enough, Ted, to know that you have had a lot of concerns about the level of valuations. And so when you said that it could do well in Q1, could go even higher after that before things head downwards. Are you envisioning sort of like a blow off top? A lot of people have called this the everything bubble, and most bubbles end with a incredible but very short-lived mania where the prices just go higher than anybody could imagine for a brief period of time. Are you expecting something like that, or maybe something a little more pedestrian?
Well, it's more along the line. You got to remember all the 401, a lot of 401k money gets put in the market in January in the first quarter, and there's a lot of that happening now. And those people aren't thinking at all about a sell-off. They're just driving it into the market. So you'll have that happening. And then you'll have a bit of probably just inertia from, this year going into the first quarter. And yeah, you could have a peak. I mean, if I were looking for more of a generational top, I wouldn't say necessarily 26, but I'd say sometime happen in 26 or 27, because by that time you're almost a generation past the '08 low. And so you've got a whole generation that's never seen a really more significant bear, And so you got to remember that the market has a way of taking every generation and sort of humbling them down somewhere along the way. And I suspect that'll happen in the next 2 or 3 years.
Okay, and let's talk about that for a moment because you have been, in money management for a number of different cycles. And we've talked about kind of what a true bear market looks like. And correct me if I'm wrong here, but I don't think you don't think we've really seen a bear market since '08. 2022, sure, that was a rough year for investors. But on some long-term trend lines, we didn't really break below the long-term bullish trend. And it certainly didn't end with the kind of capitulation that I've heard you describe a true bear market has, which is when nobody wants to touch a stock and everybody just sort of swears off them for a good number of years. So I guess my question is, are you expecting when we get to the end of the ninth inning here, whether it's 2026 or 2027, that will be because we are entering a true bear market?
Well, I suspect so. Number one, if you look at demographics, by that time, 27, you'll have the average baby boomer be 72 years old. They're going to be taking money out of the marketplace. But the other side of it is that these things come and go. We're two standard deviations plus above the norm on these averages. And I don't think I've ever seen a level of complacency, even in the 90s, late 90s, any higher than it is today. I don't think investors generally wake up every day and even remotely think about anything that could be bad happening in the next year or two. They just stay the course and put more money in the same way. And I think the advisors do the same thing, which is one of the problems you have. But that's when you get everybody on one side, like we are now, and the economy runs on the market, then you got everybody basically set up for something that's probably not going to work in the long run.
Okay, so the way you're describing this, here's sort of how my brain is thinking, which is we have this very high degree of valuation and complacency that you just mentioned, right? So markets are very rich and nobody's really worried about it, about a downturn. Um, uh, we have the potential, as you've said here, for the jig just to be up, and eventually we enter into some sort of correction here, and so that could be a real surprise for people because, to your point earlier, um, I mean it's been almost a generation of investors since the '08 Great Financial Crisis. So you have these people that just, I mean, how long ago was that? That was
Yeah,
17
16
years
to
ago.
17. Yeah, yeah,
Yeah.
17.
So you've got a bunch of investors, retail investors, and you've had a bunch of Wall Street professionals who now have spent, a good chunk of their career and never been through a true bear market, right? So, you know, you've got high valuations and complacency versus the inexperience of knowing what to do with a bear market when one arrives. And then you're adding on top of that, this dynamic that I've talked a fair amount with housing analysts about, but I haven't talked to too many people in your line of work in terms of money management about it, about the boomers. Uh, in the housing market, you're looking at kind of like 20 years, or more, which is kind of the cohort of the baby boomers, of sustained selling pressure as boomers get to the age where instead of, for the past bunch of years, we've been having 10,000 of them hit retirement age every day. Pretty soon, and really even probably starting around now, you're getting to the point where 10,000 of them are having to downsize their house, either because they're heading off to the nursing home or because they're dying, right? And that's going to sustain for a long time, as I said. So that's going to have a lot of downward pricing pressure on the housing market because in a lot of cases, when a boomer leaves their home, the house gets sold, especially if they have multiple kids, because the kids don't know who should get the house. So they just say, you know what, let's just list it and let's split the proceeds. Is there an analog to that in the stock market where boomers are dying with their portfolio and then the portfolio has to be distributed? Is there any sort of selling pressure component associated with that?
Well, I think the selling pressure comes more at them from taking care of them. As soon as they start waning as far as health or go into assisted living or that sort of thing, they start burning cash then. It's
Okay.
not like before. And so, the children or whoever takes care of it has to start liquidating to take care of that. And then they run into maybe some major things where they have to really spend a lot of money on health. I think that's one of the driving things. Secondarily, yeah, there'll be some of that fallout. But the thing is, when you have, no matter what, when you have everybody that owns the same thing, then all your buyers are in, you see, no matter how you want to calculate it. And
Yep.
so the next thing is when people start to realize they need to sell something and you flip it and go the other way. And I've been through that before. You get up every day, the market's down and it rallies in the morning for an hour or two and you think, hey, it's going to come back. It never does. It's sort of like it is now in reverse. You get a down day and everybody's no big deal. We'll be up tomorrow, the next day. And
Mhm.
that's what's happened. That's why people are complacent. But you flip that scenario in a bad market.
Well, so you flip it in a bad market, and again, you've lived through a number of different market cycles. What you're talking about here, maybe I hate to use the word different this time, but maybe a bit different this time because I think you're familiar with Michael Green's analysis of passive capital flows,
Yeah.
and he talks about the passive bid, and he's done a lot of really rigorous research to show that it's a big factor in stock prices. In fact, maybe the dominant factor right now. And he's almost kind of depressed by this, but he's like, I think it's going to continue for as long as passive capital flows are positive. But if they flip negative, which they likely will at some point, then watch out because you're going to have this sort of sustained selling pressure, just like we've had this sustained buying pressure for the past, couple of decades from it. So, as the boomers, to your point, as they're starting to get sick, needing to cash out on their financial assets, that is, like I said, maybe, 20 years or so of just relentless selling, and that may be what pushes passive capital flows into negative territory because rather than putting in, they're taking out.
Well, it could be. I mean, people are, they don't take losses very well.
Hmm.
So, if you start turning the tide on them and go the other way, then what happens to them is they say, well, I need to sell now before it goes lower. And it's a snowball effect is what it is. And, again, I think people have basically come to the conclusion that you're never going to happen. I mean, that's basically what I see with people doing. That's never going to happen, and so, you can't really talk rational with people because they're basically irrational right now.
Hmm. Okay, so we've got people thinking, all right, it's going to be summer forever. You're raising some issues that
Mhm.
say, hey, look, winter's going to come at some point and could come as soon as next year. Um, I'm going to get to in just a second. All right, well, so how do you manage capital, which you have to do in this environment? And I don't think it's a go to 100% cash and just sit there environment, at least not yet. Um, Before we get there, though, let's talk about some things that are happening the moment that we're talking here. So the day that we're recording this, silver just broke out above 60, $60 an ounce. And silver's been on a tear all year, as has gold and the mining companies. Bitcoin is also surging today. I think both silver and Bitcoin today are up
Mhm.
about 4%. And I think one of the reasons for that that's being touted in the markets right now is people are thinking that they're sniffing out that the Fed is actually going to be quite dovish when we get the FOMC release tomorrow and hear from Jerome Powell's press conference. Now, by the time this video comes out, folks will know what Chair Powell has said. But anyways, curious to hear your thoughts right now on kind of the rallying in the precious metals, whether you think the Fed is indeed going to cut tomorrow, what you think the Fed's going to be doing in 2026, and then we'll get to a couple of other asset classes too that are on the move.
Well, we own silver and we own silver miners, have for a long time. I say a
Hmm.
long time, for a couple of years, but um, we we had, we knew that, if you look at sort of a real prices adjusted for inflation,
Hmm.
silver is not anywhere close to where it's been a couple of other times.
Right.
So you could still get a lot more out of silver. And I think all the metals really offer, it's getting to one of those things where countries hoard everything, Adam.
Hmm.
And so they're hoarding everything, every metal you can think about, every precious sort of mineral you can think about, and that's becoming a big deal. And I think in the other side of that is that they're just buying that instead of other things. How long does it last? I don't know. These things don't usually last a generation. They're normally like, you know 4 or 5 year moves, but we can see. But I mean, well, like I say, we own silver, we own the miners, and also some of the royalty companies that have silver on the royalties. But uh, just have to wait. Now it's broken out a new territory here, price wise. You'll have to see how people chase it. We're starting to see a little bit of chasing. Not a
Hmm.
lot though. Institutions don't own much of it, but individuals are starting to go the other way with it.
Yeah, and do you expect the institutions to jump in before this run is over? As you and I have talked about, I think over the years, Wall Street's not a big fan of gold and certainly hasn't been of silver for a long time. But more than anything, Wall Street loves momentum and the ability to make profits. And when there's a party going on, eventually it likes to join.
Well, I think the miners got really, if the miners do really, really well and they're left out, I'm talking about Wall Street's left out of that, then the thing they would do is chase it. And that's usually what they do with any asset. They chase it at the top and just drive it higher. And that's when you see the volumes go up really, really big, then they're coming for that sort of thing. Same way with gold miners. And we haven't really quite got to that point yet. We got a little bit in gold mining here a few months ago, but the chasing's kind of slowed down a little bit right now. And generally, I don't see the institutions just trying to buy hand over fist in there.
Okay, but right now you're not changing your allocations. In other words, at least you're not selling your allocations, it sounds like.
No, we sold some of the miners about a month ago. Not a lot, I mean, but when you get large moves like that,
Right.
you know,
100% this
yeah,
year,
100,
a lot of them.
in some cases 150, 200%. You have to, you need to, at least in this case, take some off because you're not dealing with a company that's making widgets or making a product that's going to be around for, 20 years. I mean, these commodity cycles come and go, particularly in the metals. And when you get that kind of move and it just been sitting there for years, then you have to take some of it off the table. You
Mhm.
should, I think.
Okay. Um, I know we've talked in the past, you have said you don't really think it's sort of a 60-40 world anymore. And if I remember correctly, I think it was a 60-30-10 was sort of the new model you guys were taking on at Oxbow. Am I getting that correct?
Well, we had what we call a 30-30-30-10. We had
Sorry, that's it. That's it. I
yeah,
knew I was misremembering. Okay, yeah.
and we sort of have that now. We have, you know, 30% in short-term treasuries. By short-term, I mean less than 30 months. And then, 30% in basically in commodities or commodity-based things, and 30% in stocks. And that can be a value or growth company, and then about we think you need to keep 10% or more just for trading purposes. In other words, you're going to have situations where things get really cheap. We've had a lot of things get cheap this year that we stepped in and used cash on. Not necessarily household names that you'd see every day, but things that were really, really good buys. And I think that's what you have to do in this kind of atmosphere. I think the idea that you can buy a long-term bond now is not a good idea. Uh, I see people generally losing money on those for a long time. And to me, if you're buying 20 or 30-year bonds, you're making a bid bet on the fact that they can keep inflation in check, but I doubt that they can, over the long run. So that's why we wouldn't step out past, 24 or 30 months with the Treasury.
Okay, so let me just make sure folks took note of that. So the 30-30-30 allocation, 30-30-30-10 allocation that you think is more appropriate now is short-term safe debt instruments that are producing some income, stocks, commodities, all of those at 30%, then 10% basically dry powder to take advantage of opportunities as they come up opportunistically. You don't like long-term bonds I'm going to guess, kind of for the foreseeable future. My question on that is, and we'll tie this back to what the Fed, may do this week, is the Fed is in cutting mode again, and there's people out there that say, hey, look, if the economy is going to slow next year, as you think it likely may, Ted, that if it slows too much, at some point we're going to get all the intervention, the central planning intervention to try to, rescue things, and that at that moment, that will drive bond yields down, that will drive the prices of bonds up and the prices of longer duration bonds up even higher. So, that's sort of a short-term opportunity. Do you think that could happen? Do you think that that's not worth playing? That's more like trying to catch nickels in front of the steamroller, um, or is that a real opportunity?
Well, I think you're right on the short-term rates go down, but I don't think the long-term rates go down. To me, I think people will say, hey, I don't trust you, Federal Reserve or federal government.
Hmm.
They were going to try to keep this in. Look at it right now. The 10 years stuck on 415, 420. You would have guessed with all the talk and everything we've had about lower rates and coming up here, on the decision that you would have seen that change as well, but it didn't change. And it's worse though on a 30-year bond. If you say, okay, I'm going to buy a 30-year bond today and I'm going to say that I'll take 4 3/4 for the rest of my life, basically for 30 years.
Hmm.
I think that's a bad move. I mean, that's a long time, number one. And number two, you're betting on a government that's basically flat broke and going to be more broke. So to me, that's the worst of all situations.
Okay, I totally get that logic. Okay, So, do you expect, and again, I know viewers will know the answer to this by the time they're watching this, but at Oxbow, are you guys along there with the market expecting the Fed to cut tomorrow?
Well, I just assume from reading that they would, if you
Mhm.
see the people that have come. It's interesting, Jay Powell hasn't said much the last 2 weeks, but everybody else has been talking. He hasn't said much, and I guess he's just sort of waiting to see how the votes check out. But
Mhm.
it looks like that's what's going to happen. I don't think they need to, Adam, but it looks like if you think about it, we're one of the few countries, us and the Bank of England, that are cutting rates. Heck, everybody else is raising rates. I mean, look overseas. I don't know what we're doing. We obviously don't have a Fed that's independent, but we're in a different mode right now. And for them to be in and come in and get aggressive on the downside, it's just all political, and
Yeah.
it'll end up blowing it up again with inflation eventually.
And do you expect the lack of independence to increase as Powell gets replaced with the president's, latest appointee?
Well, it sounds like he wants a rubber stamp Federal Reserve, which is not good, really. They need to be able to do what they think's the right thing to do. And, there'll be a bunch of name calling as usual and all that sort of stuff, but it's not good. In the long run, they need to be able to look at the two things they're set up to do. But I think what's happened is between the Federal Reserve and the federal government, the last 25 years, 30 years, they've gotten so accustomed to saving the stock market, and the
Hmm.
stock market was the only thing that keeps the economy going, that they're stuck. And so they're probably going to do whatever they need to do to make things go, which may be lower rates significantly, but the hangover from that won't be good. That's the point I'm making.
So let's talk about that for a moment. So, we started this conversation with you talking about how richly valued the markets are.
Mhm.
And something that we've talked about in the past has been sort of the resultant K-shaped economy, right? Which is that the people who have assets have been doing great, where the majority that don't have many assets, especially financial ones, are getting increasingly left behind. And it's that top end of the K that's really doing the lion's share of consumer spending these days. So if we do get to a point where there's a substantial market correction, then you have a big negative wealth effect on that top end of the K. And then that impacts the economy. To your point, we've gotten to the point where the stock market tail is now wagging the economy dog. So yes, you expect the central planners to kind of rush in when things are starting to come off the rails and do whatever they can. But as you said, there's going to be a hangover process there. How bad do you expect that to get?
Well, what happens is, I think it'll look more like the Arthur Burns era of the 70s, where he would lower the rates, thinking that we're going to really get this thing going, and then inflation would come back, so he had to come back and raise the rates, and so that was sort of an experiment for 4 or 5 years.
Hmm.
And Burns was horrible as far as he didn't do the right things, and finally, really, Volcker had to come in and clean up his mess. And my guess is you'll have some instant, something happen. I don't know, in the next year or two, and it changes all of that. Where they can't they can't affect things as much as they used to be able to with just lowering the rates.
Hmm. Hmm. I've had a number of people on talking about sort of the point you get to, at least with monetary policy, where you're pushing on a string, where kind of no matter what the Fed tries to do, monetary policy, QE or whatever, it doesn't, you get the laws of diminishing returns where it just does less and less.
Well, I think too they'll just keep on printing. Because we have nobody in Congress, not at either party, no person. You never hear them talk about, we need to slow down spending and maybe look at this or look at that. It's just a spending spree. What have you done? It's all about themselves, really.
Right.
And we just spend money and waste a lot of money. And until something happens that'll bring you to your knees, like a World War II or a depression or a crash, something that you're not expecting, COVID, some things you're not expecting, then they can't control anymore. And I wouldn't be surprised if it's not something like that. I don't know, but there'll be a point where they can't control the outcome as well as they expect.
Okay. We're talking about some dark things. Let me try to channel the administration for a moment. At least Treasury Secretary Scott Bessent, who would say, "Hey, Ted, we've been working really hard here in 2025 to pass all the legislation we need to really start getting this economy goosed and strike all the trade deals and start reshoring jobs and bringing trillions of foreign capital in here. And we're deregulating and we're getting all this, 30 plus billion of tariff revenue now every month. Like, just have a little bit of faith, man. Middle of next year, man, we're going to be firing on a bunch of extra cylinders here. It's going to be great." What do you say to that?
Well, the first thing I would say is I was talking to Mr. Bessett. Is Mr. Bessett, how many times have you had faith in the federal government for start with? Number one, but number two, I think manufacturing jobs. And I may be wrong on this, but I think they've actually declined a little bit this year in the U.S., if I'm not mistaken. I think I've read that a couple of times. But the other side of it is they do these things and get back, like this $12 billion. They're saying they're giving back to the farmers. Well, they took it from the people that pay the tariffs. The whole thing is, see, that's crazy, that whole thing. And then you come down hard on China, and then you realize, hey, China's got the cards, we don't. And then I've got to go over and be a nicer part. See, all of that's it's just grandstanding, and it doesn't work in the long run. I do think this about what Scott Bessett thinks. I think deregulation is better. I think they've done that. I think they've done a great job on energy, on the way they're approaching it. They've got a really good energy secretary. I think there's 3 or 4 things that they've done that are better, be better for the economy. Whether it all pans out that way, I just don't know. We've run so hot on AI that if it slows down, then what's left to pick up the slack? I don't know. And
Okay.
I'll tell you, that's one of the reasons when we're buying companies, we just look at the company. We don't try to buy the averages or indexes or things like that, because that's all macro. But if I can take a company and look at it, I can tell you where we can make some money in that company, I think, over the next 5 years.
Okay. So fair to say your approach is a bit more of a Buffett type approach, where you're just looking for great companies that produce great cash flow and hopefully try to buy them at a good valuation.
Totally. That's what we do. And when you're doing that, you take yourself away from having to determine, what we're going to do on the world market and what's going to happen with the Fed. You're just looking at a value of something. It's a really good value, and you're saying, okay, I'm going to own that for various reasons. There's some really great buys this year. I don't think the average person bought them, but there's been some really great buys this year, and I think people miss that point. They just keep driving into the indexes, and the indexes are controlled by just a few companies, so they never get a chance to really own what I consider to be some really, really good businesses.
Okay. Well, let's talk about those great businesses that you picked up this year. And the other question I was about to get to, especially since you mentioned energy as one of the areas where you think the administration's doing well. I'm very interested to get your thoughts on the energy sector as an investment class, because it's been a real disappointing one for many years. But there's a lot of talk, at least amongst the folks that I interview now, that it might be starting to turn. This might be a good time to be investing in and try to catch its upswing. So answer that however you'd like, because I'm going to guess some of the companies you bought this year might have been in the energy sector, but you tell me.
We bought a lot of energy this year, but it's interesting. I know generally people are off on it, but most of our energy investments this year are up for the year. They might not be up 40% or something, but they're up from where we bought them. And if you look at the energy sector, to me, over the next 2 or 3 years will be the best buy you can make right now. Because if you look at the dividends in that group, there's a lot of them that have 7, 8, 9% dividends. And, we just bought Petro Brazil, 12% dividend, biggest oil company in Brazil. I mean, all you got to do is get a turn. You have to realize you go much below $55, $56, and they won't be drilling. They won't be doing anything. You have to make enough money to do it. So, it's still a supply demand thing. And granted, you might be in a situation where for the next 5 or 6 months, you're just collecting the dividend. But if you look at that total return over the next 2 or 3 years, you're probably going to do really, really well. I mean, we bought numerous things this year in the energy section. There were dividends anywhere between 6 and 10, and that's great cash flow right now for this time we're in.
Okay, so I know that like nuclear plays have done great this year, largely banking on a lot of future investment by the country in this space. But a lot of the actual cash flows from that are years and years in the future. Oklo is a great example of that. They're not going to have a dollar of revenue for many many years, but the stock's
Right.
done fantastic this year. I assume most of the companies you're talking about that you're buying this year are more in the fossil oil and gas space.
Natural gas and oil. I mean, I think if you look at solar, for example, the way we've sort of played solar is we own silver, use a lot of silver in solar.
Yep.
And so we kind of go that different direction. But generally, we're oil and gas. We own one small company that's in the service business in the Mid East. That's a great little company, uh,
Hmm.
National Energy, NESR. So all of you out there, but it's a small company that makes a lot of money. Just signed a big contract, but that's the only service company we own. Everything else we own is either is really oil or gas, and gas has done really well for us this year, really well. But I think it'll do a lot better in the future. And so that's really where we are. We're if you look at what we've added the most to, it would be energy this year.
Okay. I just got to ask since you mentioned it. I've interviewed again folks who invest in this space, and a lot of them have been pretty bullish on the midstream companies. But
Mhm.
sounds like you guys only own one. Why only one?
Oh no, we own 3 or 4. I didn't mean to imply that. What I mean is we own the gas producers that are not midstream. They're
Mhm.
actually producing it. We own Antero, for example, Northern Oil and Gas. We own Apache or APA, which are the old Apache. But we own. If you look at what we own in the midstream, they're mostly LPs, but MPLX. If you look at Energy Transfer, Enterprise Products, see those are all paid on a K1, but our average yield on them is somewhere around 7.5%, which you can't get today, Adam, in a real estate deal. I mean, I mean,
Right.
I think, and they raise it every year, and so they've been great. We've owned those for many, many, many years. I'm talking about 20 years now, and a lot of them. And so, it's that's an area that if you look at Enterprise Products, we've been on that stock a long, long time. It's been a great company, but we own those are the midstreams we own. But they're almost all of those are an LP and they're on a K1, but we own the straight up gas companies too. And that's why we own when you look at on the oil, we sort of separated on the oil, but we own various oil companies, Matador, like I say, we just bought Petro Brazil, and it's a good group. I mean, it's a group where you can make some money. We think the next 5 years, but you got to stay with it.
Okay. Well, thanks for clarifying. And I've been a silver investor forever, but I got quite bullish on silver when we had the price breakout at 35. And I know you follow me on X. You probably noted where I gave myself silver eyes at that point, and then one of my followers added laser beams to the eyes. So I've had silver laser eyes since 35, and that's proved out well now that silver is above 60 on the day that we're talking here. But I've been saying of late when I retire the silver laser eyes, I might replace them with oil eyes because of the potential for this industry to turn. And I think you share that optimism. Let me ask you this, Ted. Your firm is headquartered in Texas, so you know a lot of people in the oil industry. How much of your enthusiasm is because of your approach to valuing companies and just doing the homework you guys do on the fundamentals versus what you're hearing from people in the oil industry about their sense of its prospects in coming years?
Well, I think they generally feel good, and we've seen that business shift a lot on the private side. You see a lot of mineral business. In other words, a lot of royalty overrides, that kind
Hmm.
of thing, and they're making, and it's big. Everything's big now. It's not like you can't go drill a vertical well like you used to 30 or 40 years ago, and I hope you get a good well out of it because everything's horizontal. All the horizontals are getting longer and longer.
Right. Well, the easy stuff was extracted a long time ago. We got to go
Yeah.
deeper and deeper. Yeah.
Yeah, but that's kind of where the business has gone to. But I still say this, that they need a price to really expand that. They need a price, and it's not like they're not doing anything. But in the long run, a higher price is going to really expand that, I think, to a high degree. And so in the industry, and I hope people don't get irritated with him, but the oil industry is not a good industry for sentiment. At the lows, they won't buy anything.
Hmm.
At the highs, they think we're going up forever.
Hmm.
And so I used to laugh at a lot of them because I'll tell you a story back when the oil late 80s, it was, I guess it was, I can't remember exactly the time, but oil was, um, had gone down, it had gone down to about $10 a barrel or 11. And I asked this one oil and gas guy, I said, what do you want to just go out and buy it? Because I said, well, how much does it cost to lift the oil? If you just drill the well, he said, that's probably about 14 and a half, $15 a barrel. I said, why wouldn't you just buy it then? And he said, because it might go lower.
Hmm.
so, so if you think about, excuse me, if you think about that, it's kind of it's contrary thinking, but that's kind of what the industry does.
Okay. All right. So don't rely too much on the industry sentiment because they oftentimes get it wrong, especially
Sometimes.
at the edges. Um, so a couple quick things. So I think you already said this, but I just want to really make sure folks listening understand it. Given your optimism, I don't think it would surprise you if the oil price continued to drop for some material period of time here, say into the middle of next year. You're not calling the bottom in oil here. You're just saying you like the longer term prospects of this space. And even with a declining oil price, as you said, a lot of these companies you own are going to be paying you nice dividends. And then if and when the industry does turn, you'll get the best of both worlds, where you'll get those dividends and a rising share price.
Well, it's true because, at the top, oil was 30% of the S&P. And I don't know what it's 3.5% now,
Yeah, it's like
whatever
low
it is.
single digits now. Yeah.
Yeah. So what happens is, yes, it could go lower, but we would just add to holdings if it did, because we would be getting more cash flow. And in the end, that's what all investing is about, is cash flow, no matter what kind of investing you're doing. But yeah, it could get weaker. It could get a little weaker. I wouldn't see it past 50, 55 though. I think you get down to that level, I think people they just stop.
Hmm. Well, I'm selfishly, I'm kind of hoping it weakens from here just because I
Mhm.
want to be able to dollar cost average in at lower prices in the near
Yeah.
term. I'll also say too, a lot of the natural resource experts that I interview, Rick Rule, being very notable amongst them. Rick says, look, if you look at the growth of world demand for oil and gas, it's just a ever increasing line, right? In other words, even though we've been investing in alternatives and we're excited about nuclear, it's not placing a dent in the world's demand for these fossil fuels. And he said, in spite of that, we have actually been decreasing our capital expenditures in recent decades in terms of exploration and development. And he said, look, even if demand were just a flat line from here, not even grow, he says, we're going to have some shortages in the not too distant future. I don't think you necessarily need to buy into uh, that theory to want to invest in oil and gas right now. But certainly, if Rick's true, if that proves to be true, that'll only add some pretty substantial tailwinds to this sector, correct?
Yeah, and Adam, there's so many places in the world that the only energy they have is combustible energy.
Hmm.
We forget about that in the U.S. That there's so many places in the world that's the only kind of energy they have. They don't have any other kind. And yeah, it'd be nice to have electric, but they don't even know what electric is in many cases.
I was
And
going to say,
so,
I mean, there's still, well over 1 billion people, maybe more, who don't have electricity or drinking water.
so yeah, you're right about that. I just think, you don't want to put the whole portfolio on energy, but it's just one of those things we think is undervalued right now.
Okay. Anything else that's on your, opportunity set of, hey, this is something that we particularly like right now that we haven't talked about yet?
Well, we have two different sets. When we talk about that 30, 30, 30, 10, that 30 that's in stocks is in a different look. And we've been buying companies, just a few names that we bought, for example, in the last couple of months that you wouldn't probably think about, or like Domino's, Gildan, if you own the t-shirt company that makes a lot of activewear, Mercado Libre, which is kind of the Amazon down in
Oh my
Uruguay.
goodness. Sorry to
Uh,
interject. That company was founded by one of my business school classmates, who I believe is a billionaire now.
well, probably is. But Autodesk, Bristol Myers, and those are in the stock side. Um, on the high income portfolios we run now, that's where we have a lot more energy, but also we have a lot of different other things. We own Vale, which is a Brazilian mining company, a lot of iron ore, other ores. Rio Tinto. Now, these are all foreign companies, but they do great. You know, a great little fertilized LP that we own is CVR, and pays like a 12% cash flow,
Wow.
and that's a nice little LP. But they're different things we own over there. A lot of fertilizer we own, in copper we own different. That's where we have a lot of the commodities in that portfolio.
Okay. And in terms of portfolios at Oxbow, um, I'm painting with a very broad brush here, but as I recall, you kind of have three main portfolios that you're focused on. One is the growth portfolio, if we'll say, which is largely the equities that you were just talking about. And then you have two income portfolios, correct? One more conservative and then one more high income.
Right. The conservative portfolio is just for people that don't want to lose any money.
Hmm.
And so and there, you might not think this, but there's people out there like that, or they want a certain percentage like that. So they'll have more than one portfolio. The high income portfolio, though, is aggressive. I mean, we own things that pay a lot of cash flow, a lot of dividends, a lot of interest, and it's widespread. It's sort of worldwide. We own a lot of different things in there, but they create a lot of cash flow, and that's where we own a lot of the gold miners, gold, silver miners. All of that's in that high income account, and it's had a really good year this year. But we're running in that portfolio as good a year as it's had. We have about 55% still in short-term treasuries.
Wow. So even with that drag of just short-term treasuries, you're still having one of your best years.
One of the best, yeah. Our best years are always off market lows. That's where we have our best years, but
Right.
that's just because we have liquidity. We're not brainchilds or anything, but we have liquidity. So you can put liquidity in the market at the lows, and that's where you're going to get really, really big returns for a year or two.
Yeah. And your growth portfolio, the one that's much more just in equities, I recall the last time we talked, that was pretty healthfully in T-bills too. In other words, you weren't fully invested in that portfolio. Where are you now?
It's about 38, 40%, probably right at 40. And it's only running on a risk-adjusted basis. I mean, it's not running that far behind the S&P, but you have to think about it. Uh, it's a more conservative portfolio if I can have a really good return, but not have it all in the market. And so that's really where we come from on that portfolio.
Okay. So, uh, folks, just full transparency, I am a client at Oxbow, which is one of the reasons why I kind of know how the firm is structured there. And some of the things that I appreciate is the fact that the firm manages these three different portfolios. So, you can sample from all of them, right? You can say, okay, look, I want some of my money managed super conservatively. I want some of it to be getting income, and I want some of it to be striving for growth. So you have the ability there to kind of custom build your allocation. But I also like the fact, and this is me personally, you don't have to, your outlook probably shouldn't match mine. But I like the fact that even while they're striving to get the best returns they can, they are cognizant of the high degree of valuations in the markets. And so they have these cash reserves in the portfolios so that if and when there is a bear market, they've got the dry powder to then really lean in. And as Ted has said, the firm's best years historically have been the ones coming out of a bear market where you kind of have the blood on the streets. And it's the people who have capital to deploy when you've got those really cheap valuations are the ones who then really ride the recovery in the markets from then. So anyways, Ted, just underscoring why I'm a pleased customer.
Well, thank you.
All right.
I mean, everybody's the same. I mean, we don't really, all our portfolios are alike. If you choose one of them, you're going to look like everybody else. And it just depends on what you want, how you want to look at things. Everybody's different. We understand that. And generally, I think people today probably ought to take a look and say, how exposed do I want to be to the overall market? And we're seeing, I mentioned this before to you, but we're seeing more and more older people, 75 plus, 80, that have a lot of their money. I'm talking about 85 or 90% of their liquid assets that are in the stock market. And I just don't think they're thinking about the big picture when you're that age, and have that much exposed. But again, life's been good to them, so sometimes you can't make a case for them.
Well, it's sort of confirmation bias, right? You get
Yeah,
used to the way things have been, and then you say, well, of
right.
course they're always going to be this way. And this is what I think is the potentially nefarious trap of what you were talking about earlier, which is we're kind of a generation since the last market bear market. And so people have kind of just acclimated and said, you know what, I don't think the markets are as risky as they were. Even the ones who should know best, right? The older
Yeah.
investors, they've they kind of just think things have been different. Of course, every year the market goes up double digits, it reinforces that bias. And as I said earlier, we've had three great back-to-back years, right? So
Yeah.
let me ask you this. So obviously, if you are near retirement or in retirement, I think you would say, Ted, hey, be cautious. Don't be all in stocks the way that some of these people that you're seeing, seem to be, right? So one, just be careful. But for someone say my age, who's in their 50s, um, I've definitely been more conservative than the average investor. And I've seen people who, in my opinion, who have been more reckless than me do better than me
Mhm.
because they're all in the Nvidias of the world or the meme stocks or whatever, right? And they're playing the game as it's, you know, is working right now. I mean, I can't really fault them. They're getting rewarded for playing the game that's delivering a winning hand. It's just to me too risky, right?
Yeah.
Um, and I talked about that K-shaped economy earlier, where the bottom, half is seeing the top half get further and further away from them. Um, might there be an opportunity here if we get the kind of corrective event that you think might happen, where there may be the potential for people who are kind of paying attention and being prudent to kind of change their station here positively, to kind of almost slingshot into the higher echelon, which is avoid getting big losses if and when the trades that have been doing so well stop working and then maybe go into reverse, maybe pretty substantially, and then also have that dry capital to then put into play when there are really good valuations to then ride what comes next. So you might be able to take yourself from kind of a middle of the pack player here to a front of the pack player if you play your cards right.
Well, no question about that. I mean, when you get, I think the hardest thing for an average investor, though, Adam, is determining when is it cheap? Okay.
Hmm.
It comes off 15%, and they go, gosh, I ought to make a good buy. but it's like it was like for us in 2008, the market went from the Dow went from 14,700 to 8,800, big sell-off by the time we got to October. And then, believe it or not, and we put some money in. It ended up being great to put it in then, but we kept a lot of money back. And by the time you got to March, the first week in March of '09, we went down another 25%. We went to 6,600. And those are the points I'm talking about with people. I don't think the average investor is real good at knowing how to scale in and out.
Mm-hmm.
They're like all or nothing. And
Yeah.
that's a tough way to run the business. You have to know when to scale in and scale out. If you have a huge winner that's gone up 15 times, 20 times, sell some of it. Take your cost out, take some profit out. You never know what the future is going to hold. And the same on the downside, you buy a little bit, it goes lower, you buy some more, but you're looking at a longer period of time. And I think the average investor, it just doesn't know much about scaling.
Well, this is one of the reasons why I recommend so strongly that most people work with a professional financial advisor because one, it sort of takes the emotional decision making out of your hands, and then you're also leveraging the expertise and the experience and the level head of the professional. Um, I also imagine if we do get this big corrective event in the markets, from what you've told me in the past, Ted, when it's the right time to buy, it's going to feel terrible to do so,
Oh,
right?
yeah.
This is when nobody wants to touch a stock and it feels like you're just throwing good money after bad and all that stuff. So you really have to have some sort of either framework or guide who is going to start guiding you on the scaling in then.
Yeah, for us, we just, we look at the single company, and
Hmm.
it may be so cheap, it's incredible. Not that it couldn't get cheaper, but if I could make a case to somebody, if you own this whole company, and it's real cheap now, and you own the whole company, you would buy this whole thing and just own it as your company because it will do that well over the next 10 or 15 or 20 years. And that's how you have to look at it on the lows. You have to decide, would I buy the whole company to really get aggressive? And that's really sort of the way we look at it. And it's the same way on the highs. If we get stocks that are so expensive, would we ever even think about owning this whole company? No. And so then you sell some. So it's on both ends really.
Okay. Well, Ted, look, this has been, as usual, a fantastic discussion. We're coming up on the hour here. I do want to spend a few minutes talking about the free webinar that your firm is offering next week on succession. So, I mean, we're going to get into the weeds of it in the webinar itself, but can you just talk for a minute or two about the importance of it? I mean, you, again, have spent a long career advising people. Your firm specializes in high net worth clients, especially entrepreneurs who have had a nice liquidity event after selling their life's work. Um, you've seen firsthand, the person who has worked so hard to build the family wealth, uh, but then need to say, look, I'm not going to be around forever. So how do I make sure that all this gets managed the way I want it to if I'm not around anymore? And I'm sure you've seen the good and the bad, people who have planned well versus people who haven't planned well. So why is this such an important topic?
Well, I think the biggest thing with it is you don't know what your future holds. And so, from an age standpoint, there are going to be things that you didn't expect. We get this every year, we get a few of these where one spouse or the other did all the investing, but all of a sudden they have Parkinson or a stroke or they're an invalid, they can't do it anymore. And then the spouse that's remaining uh, really has no idea. Now they don't even know who to trust. That's another. See, I mean, so you have to spend a lot of time with them just so they understand, hey, you can trust us to do the right thing. But see, that should have already been in place. You didn't have, I mean, we're not trying to take the car keys away from you. All right. I mean, well, my point is you don't have to do the whole thing, but you need somewhere along the way to have a relationship with people so that and you may just get to the point, we've had people do this and say, I'm tired of it. I don't want to look at it every day. I'm going to enjoy life. I want to travel.
Oh,
This
spend time
style
with my
of living.
grandkids. Yeah.
I'll tell you something else, and I'll mention this before, but now when you call, we have a lot of custodians, and I don't talk to them myself, but I know what goes on. And if you call, the Fidelities and Schwabs and the Vanguards of the world, all the big custodians, and you get somebody on the phone, about, a lot of them are just lost. So they lose you too. I mean, what I mean is you don't know you're trying to get something done, but you don't have the capability to do it. And that's when you got to start thinking about, okay, I could use somebody to really help me here a little bit. And again, you don't have to give them the whole thing. I understand there's an ego thing in there, but it's certainly something to think about.
Yeah, there's an ego thing of not wanting to give over the reins. There's also sort of a, you know, humans don't like to think about their own mortality. So it's one of these things,
Yeah.
wow, I don't want to think about it now. Maybe we'll do it later. And then, of course, potentially it becomes too late. And I think this is such an important topic for this audience here at Thoughtful Money, because I know from the surveys I do to this viewing audience that like 75%, 80% of these viewers consider themselves DIY investors, right?
Mhm.
So they're doing it on their own, right? So, that's great. But, at some point, you're not going to be able to continue to do it. And so, to Ted's point there, you don't have to give over the reins today, but just like having a will and a trust is a prudent thing to do and an act of love to do in advance for your loved ones, figuring out who the baton is going to go to before you actually have to give it up is prudent in a similar act of love. And if it's somebody in your family, fantastic. And if they need a couple years of grooming time, of you educating them and getting them up to speed, fine, great. Just start that process now. But if it's not, and there are a lot of people I talk to who they say, no, there's, my spouse certainly doesn't want to, my kids aren't interested, or I just don't think they have the experience, I don't trust them enough to get good enough at this, then at least right now work on identifying who your successor will be. And if it's a firm, doesn't have to be a firm like well, it doesn't have to be Oxbow, but I would say make it a firm as good, if not better, if you can find a better one. And I think that's a tall order, but if you can, great, that's fantastic. And get that in place. And hopefully you don't need to pass that baton for, many years, decades, hopefully. But, just in case things happen faster than you think, at least you've got that plan B already set up. So if you are interested in attending this, I think, very important conversation with Ted and the Oxbow team, again, just go to thoughtfulmoney.com/succession, and you can sign up for free. And again, the actual event itself will be this coming Monday, the December 15th at 7 p.m. ET. And if you are watching this video after the webinar takes place, just go to that same URL and it'll redirect you to the replay video. Ted, as we start to wrap up here, I guess last main question for you, is there anything else that's burning brightly on your radar about the markets, the economy, whatever, what you're hearing from clients that I just haven't been intelligent enough to think to ask you?
No, not really. I mean, I think that complacency meter is really, really high. I mean, people are very complacent right now, and they're not worried about it. And that goes back to that do-it-yourselfers. Things have been good so long that why would you ever use anybody else? So it all goes together. When you go a long period of time and nothing bad happens, then that's sort of what you end up with. But I think people need to really stop and think about history here. Go read a few books, and then you'll change your mind.
All right. Well, very well said. Well, folks, two things. Please show your appreciation for Ted coming on and giving us so much of his time and expertise by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And you hear me say at the end of every one of these videos that if you want some professional help and you don't already have a good professional financial advisor who is advising you, that you should talk to one of the ones that this channel endorses. I highly recommend that. But if you want to talk to Ted directly and his firm there at Oxbow Advisors, there's a form to do that. Just go to thoughtfulmoney.com/Oxbow, fill out the very short form there, and the team at Oxbow will be in touch with you right away. I should manage expectations though, Ted. Your firm does have some minimums because you tend to deal with higher net worth clients. What minimum should we tell folks you've got here?
Well, and it's not that we wouldn't, people that don't have the minimum, we always keep them on an email list and try to help them as much as we can. We're just not going to be able to manage for them. But, you're looking at, typically, typically out of state, we need $4 to $5 million to manage that account. In state, not quite as much, but our average account size is going to be that size or higher. And we manage a lot of money that's higher than that as well. But we usually have 4 or 5 people on an account, so it's not that we're arrogant or anything like that. It's just that you have to look at the economics of it all, and that's where that comes from.
Okay. All right. Well, look, and when you say in-state, you mean Texas, correct?
Yeah.
Okay, great. So, folks, anyways, if you meet the criteria or you just like to talk to the team there at Oxbow, again, go to thoughtfulmoney.com/Oxbow. If you don't have enough to meet their minimum, but you'd still like to talk to one of Thoughtful Money's endorsed financial advisors, you can fill out the general form at just thoughtfulmoney.com, and you'll be connected with one of the other advisors there. Ted, thanks so much again, folks. Hopefully, we see you at the free webinar next week. And again, folks, to sign up for that again is thoughtfulmoney.com/succession. Ted, I can't thank you enough. You're such a gentleman.
Thanks a lot, Adam. Good to visit with you again.
All right. You too, my friend. Hope to see you in person at some point in 2026. Everybody else, thanks so much for watching.
First of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates.
With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes, while also not increasing public debt outstanding. Colin Weiss wrote in Official Reserve Revaluations, The International Experience on August 1st. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Noting this scenario, the speaker, Clive Thompson, highlights that the Fed isn't guaranteed to pick a revaluation target of $15,000 per ounce. They might even use the spot price instead. The Federal Reserve published a research note titled Official Reserve Revaluations, The International Experience. The paper examines 5 countries, Germany, Italy, Lebanon, Curaçao, Sint Maarten, and South Africa, that have revalued gold or foreign reserves to bolster their finances. The Fed has not committed to a specific revaluation figure, such as $15,000, using market prices, is still on the table. The study examines how other central banks have utilized revaluation proceeds to offset operational losses or provide government financing. However, the US has yet to take such a step. If revaluation occurs, then this paper profit could be converted into gold certificates and handed over to the Fed. The Fed could then credit the Treasury with new dollars, allowing the government to spend without officially increasing its debt. This is why some refer to it as a hidden financing tool for the state. Central banks have different methods for valuing their existing bullion holdings. Some value their gold reserves at their historic cost, others report it at current market prices, he said. When central banks report their holdings at current market prices, fair value, the unrealized profits or losses from valuation changes are recorded. When gold is valued at historic cost or modified historic cost, gold reserves can be revalued at market prices or values closer to market prices to generate revenues, he noted. When all official reserves are valued at market prices, the unrealized valuation changes recorded in the revaluation account can be shifted to other. Now, we present the clips from the interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
First of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates, which is not part of the USA debt, doesn't have any interest, and has no maturity date. So what they're basically doing, if they do a revaluation at any level, they are swapping the debt that they have at the moment, or some of it, for gold certificates, which is not debt according to the official the Treasury balance sheet. Now, as I said, the higher the price they do it, the better it is. So I picked a figure out of the air of 15,000. I kind of felt my figure was on the low level compared with some other people who've been picking 20,000. But of course, the level at which they'll do it, if they do it at all, would be at what level do they dare to do it without disrupting the market? Because we don't want they don't want to do a figure which is going to make people panic and say, oh my God, the dollar's worthless because they've done this. So I kind of chose that number based on what I thought would be a right number relative to the amount of money they've been printing in the past. As you know, they're printing roughly $2 trillion a year effectively in new debt to pay for the budget deficit. So the figure I picked of $15,000 would cause a new printing of 3.9 trillion as opposed to the 2 trillion a year which is being created. So that would be very, very slightly inflationary, not much. I mean, let's face it, with the amount of money which has been coming into existence over the years, it's not a big deal. For example, it's only about 10% of the national debt. Well, I think if you're buying physical gold and silver in the form of coins and bars, the thought process ought to be one of, I'll keep it forever unless there's no choice. So it's kind of like an heirloom. It's a bit like if you buy a painting, you put it on your wall and you expect to pass it down the generations. Obviously, it's an asset which can fly a little bit under the radar screen, which can be advantageous depending on how you look at it as well. So when I buy physical metals, I tend to think that I'm not buying them with a plan to sell tomorrow or next week or next year or 5 years or 10 years or at any price. It's kind of like the parachute you've got just in case the worst comes to the worst and you've got no choice. But if you want to trade in and out of gold and silver, then the way to do it is the way, I know you don't like it, Mario, but the way to do it is through ETFs or gold mining shares or things on the stock market where you can trade with a very narrow spread and at high speed. But that's a completely different kettle of fish from having a parachute. Trading is where you buy something with a plan to sell it quickly and make a profit. Whereas I think the reason why a lot of people are choosing to buy gold these days is because they fear that the financial system that we are in is getting close to the end. I fear the trust in fiat money could evaporate very quickly, and then they might be forced into a new system. And if you own a gold coin before we cross that line, you'll still own it afterwards. Whereas if you've got something in custody, subject to the whims of a third party, you're not sure where you're going to stand. You're not sure if they're going to take it from you.
Francis Hunt, also known as Market Sniper, points out that a significant revaluation of America's gold reserves could instantly boost the federal balance sheet by recognizing hundreds of billions in previously hidden assets, thereby improving the debt-to-asset ratio and bolstering confidence in U.S. bonds and the dollar. By providing extra backing for government obligations, it could help address record-high sovereign debt, while reinforcing gold's role as an inflation hedge, signaling limits to currency debasement and strengthening trust in U.S. monetary stability. Despite its potential benefits, gold revaluation would likely trigger significant market disruptions. Financial markets have operated for decades under the assumption of fiat currency dominance, and an essential shift in monetary policy could lead to substantial volatility across asset classes. Revaluation might paradoxically create inflationary pressures if implemented too quickly or without careful communication. The sudden recognition of additional national wealth could alter inflation expectations and lead to accelerated price increases in the short term. Major gold holders, such as China and Russia, who have both been actively increasing their reserves, would likely react with deliberate actions to capitalize on a more gold-driven monetary environment if the U.S. were to revalue gold. A comprehensive legal and regulatory foundation would be required for such a change, including congressional consent, coordinated action by the Federal Reserve and Treasury, and a clear implementation strategy. The foundation for this strategy may already be in place, according to recent Treasury remarks on asset monetization. Growing awareness among financial professionals and officials highlights gold's potential as a significant instrument for addressing America's debt issues, although the timing and scope of any adjustment remain unknown.
What does history show us on revaluation conduct? It shows us that government has no interest in making its citizens wealthy. What did they do previously? Roosevelt got everyone out of the metals by decree, by threat of law, massive fines that would run into millions today. It was tens of thousands back then when you bought houses for that kind of money, and multiple years in jail. What did the events of COVID tell you about their approach? They're in it to enrich themselves. You weren't given the heads up of something coming, then everyone's speculating and all jumping into pharma shares. They took the money and they closed your businesses down. What do the possibilities of the great taking tell you? The possibilities of the legalese versus the English show. When you understand where they're seeking to take us, and this is my conspiratorial nature, Clive might think, but we are looking at a global communism and totalitarianism to make everybody reliant on UBI, as large a segment of the population as possible, so that you ultimately control them. If you control the food supply and you control how they earn and what they can eat, you have the end goal that I believe these people have always sought. So the lottery hope of a 4x, 5x, 6x on gold that will benefit quite a reasonable sway. Now, as we say, hedge funds don't really have a lot of gold, but there is still in the liberty movement quite a high tendency to stack gold and silver, that their greatest enemies, and believe you me, libertarian people who seek self-reliance are invariably the biggest enemies of a totalitarian state who's seeking a great leveling in the Western markets. You are not likely to get this lottery ticket. And I don't want to be the guy behind hopium on this for a number of reasons. However, truth does out, and I think the option of a mark to market isn't far more likely. And the force of necessity and the inflation that they're going to be generating could see Nixon-esque regular mark-to-markets to open up the overdraft out of force of necessity, which probably means they'll go either for a similar confiscation or other aspect, which is a bit draconian, but depends how totalitarian we get. We're being told a lot what to do. But they can also do their unrealized capital gains, which is what probably my primary scenario, where they can enforce sales by instituting an unrealized capital gain on you. So they want to know what you have, so you're going to have to blockchain it. I would suggest maybe having some gray or black gold, which would be off-grid, illegal, and probably punishable by death, given that they're the Marxists that they are. And you probably will face capital gains tax even if you have not sold, just by virtue as they know we're patient stackers. That's how they have a plan for gold and silver, guys. Without a doubt. And they aren't going to enrich us without a clawback or an attack vector. And it's not good news for me to say that. Don't shoot the messenger. I'm just very clear about what history tells us about the kind of people we're dealing with. They do the revals after they've stripped you out. And if they're not going to be able to get away with doing that now, they're going to make sure they get their pound of flesh out of you, the Shylocks that they are. So that's my take for the question. We've got to watch for those attack vectors if they do end up giving you a decreed new price that isn't price discovery. There's a lot of legalese that will have to be negotiated. I don't believe they'll be prepared to bankrupt the banks, their shareholders. And I don't think it's a high probability, and don't get sold on hope, because then you don't get the crash of the disappointment. Mark to market is far more feasible. And I think it could regularly be mark to market, because once they do it once, it becomes the tap that they keep dribbling the drops out of and getting sustenance. So it could be repeat. And I think you should keep doubling down and keep giving them back their fiat and keep stacking. And you should have locality optionality so that you don't get taxed out of your metals. And that's what we do for our community very specifically, because it's not just what you make, it's what you get to keep.
A revaluation of US gold might reveal enormous latent value in the country's reserves, enhancing fiscal stability, fortifying the dollar, and indicating a cap on unrestrained currency production. To prevent market turbulence or inflation shocks, such a move would necessitate rigorous coordination between the Federal Reserve and Treasury, a precise legal foundation, and a well-managed communication strategy. The ramifications would be seen globally, changing monetary policy and potentially hastening the transition to a financial system that is more heavily reliant on gold, with big gold-holding countries like China and Russia ready to react strategically. What short-term effects may a gold revaluation have on international financial markets? What legal and practical measures would the United States need to take to carry out such a revaluation? Please leave a comment below with your comments on Clive and Francis's gold revaluation analysis. If you find this video helpful, please give us a like and turn on notifications to stay up to date with our latest videos. I'll see you in the following video. Thank you for viewing.
Gold is becoming more expensive. It is the dollar which is losing its purchasing power versus gold. The price has been steadily moving upward over the last 2 years. And it surges it breaks out, it surges 15%, it consolidates for another 3-4 months, breaks out, surges 15, 20%, consolidates for 3 or 4 months. This has happened 3 or 4 times now. And as most people know, it's been consolidated under 3,500 since about April or May. It's now broken out, and I think there's a rush of speculative interest because another 15%, if we keep the pattern going, takes us up to about $4,000 an ounce. I think the next move in this current move is probably to 43.5, 44. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through.
Gold's rise isn't about it becoming more expensive. It's the dollar steadily losing value against it. For the past 2 years, gold has followed a pattern of breaking out, surging 15 to 20%, then consolidating for a few months before repeating the cycle. After holding under $3,500 since spring, it has now broken higher, and if the trend continues, the next leg could carry it toward $4,000 an ounce. Silver, meanwhile, looks set for a move toward $43 to $44 in the near term, and with expected rate cuts and yield curve control ahead, next year could be when it finally breaks through the long-standing $50 barrier. Craig Hemke is a longtime precious metals analyst and founder of the website TF Metals Report. He recalls that back in 2011, silver's sharp run from $38 to $48 in just 4 weeks wasn't a bubble, but the result of a commercial short squeeze. Speculators were long while commercials were heavily short, and when shorts had to cover, prices exploded. If commercials pile on new shorts, silver will likely grind higher in a slow, stair-step move. But if they start covering without heavy speculative buying yet, that could trigger a breakout, drawing in new money and creating a powerful rally. Silver tends to sit quietly for long stretches, but once momentum builds, FOMO quickly takes hold. The current move may aim for $43 to $44 before pulling back, but next year, with rate cuts and yield curve control likely, it could be the time silver finally smashes through $50. If it does, tests that level as support, and holds above it, then the market could truly take off. If silver breaks above $50, the real stress will likely show in London's physical market, not comics. With supply deficits, limited float, and heavy reliance on paper ETF instead of real bullion, a surge in demand could expose shortages and trigger major volatility. That's when silver could truly get spicy. As we play Craig Hemp's video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
Crazy breakout camp just yet. I think it's an important time for people to be paying attention to what's going on internally with silver. In April of 2011, okay, so most people remember that, price went from 38 to 48 in about 4 weeks of that month, over the course of the month. And it was assumed, it was written up, and people look back, with revisionist history and make it sound like it was a big speculative bubble. What was actually going on, if you followed the Commitment of Traders report back then, was a commercial short squeeze. They had all these speculators that are long, all these commercials that are short, and they started having to cover shorts for, without going into all the details as to who was short and why and all that stuff. But you could just see it on the Commitment of Traders reports. And that's what took it from 38 to 48. I think, could we have a similar month now? Of course. But we want to be watching those Commitment of Traders reports because it'll tell you a lot. If the commercial side of that equation is aggressively adding new shorts this month, okay, well, we're just in that kind of stair-step phase, of 2 steps forward and 1 step back. But if we start seeing a lot of commercial short covering without a lot of new speculative money yet, and that's what drives us, well, then, when we get that breakout of, top of the cup, then you get this big rush of speculative money that just catapults you further. Because silver's a lot like, and I'm sure I've used this metaphor before, it's like Newton's law of inertia or motion or whatever it is. I took physics, but it was a long time ago. An object at rest remains at rest until a force is applied to it, right? Just sit there. My computer's right here, but if I push it, okay, all right. It'll remain at rest until a force. And that's kind of what silver's like. Silver just sit there, as we all know, and just do jack for a long period of time, even like not keeping up with gold because people are waiting. They're like, well, I'm not going to get involved in silver yet because it's just sitting there doing nothing. But then as it starts to get moving, then you get this kind of FOMO thing. Hey, we've seen this before. And so what will probably happen, I would not expect it to smash through the $48 to $50 all-time highs in the first try. That's generally not how it works. And so I wouldn't think we would get there this year. You go up, we could go to, I think the next move in this current move is probably to 43.5, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when You get to 50, or at least you finally break through. You go up, tap it, find resistance, finally break through. Everybody goes crazy, and then it pulls back, tests that old resistance level for support. And if it finds the support and you stay above 50 and then start making new highs after that, well, then, holy Toledo, then we could have some fun. And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? You know, the supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered? How many times supporting the derivative markets? All that stuff. You know, if we set off on this, you know, breakthrough 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, you know, they don't want to deliver theirs out or whatever, things could really get spicy next year. I saw that stuff too last week. There were 9,000, I can't remember, 9,900 or something COMEX September silver contracts that were open and standing for delivery when that contract went off the board. And then it gets delivered against, you know, you got to be 100% margin long covered so that you can take delivery if that, you know, you're long and somebody the short puts the silver to you. And, you know, historically, that's a lot. But back in March and May, we were doing 15, 18,000 contracts. Okay, so it's not like, oh, wow, it's 10,000 in September, you know, the system. No, it's not. No, not yet, at least. Okay, but it is a not insignificant amount. If we've already delivered almost all of those, that's 50 million ounces. I don't know if it ever actually leaves the COMEX or if it's still just this, oh, this month I'll take delivery, next month you take delivery stuff. So we'll keep an eye on that. I don't think that's where the stress is. To me, after kind of getting excited about that 15 years ago, I don't think that it's the COMEX where you'll see delivery stress. It's more likely in London. I'll give you this. I mean, you've seen over the years, Elijah, and I'm sure everybody listening has seen this, you know, we're like Stan Druckenmiller or Ray Dalio or, you know, whomever, some big hedge fund manager, they'll say, we want to own gold. And you're like, good. And then they buy the GLD, right? And you're like, well, what good is that? I mean, that gives you price exposure, but you don't really, you know, you can't take delivery, Stan. You can't take delivery.
Craig Hemke explains that the dollar index is misleading, as it only compares the dollar to other weakening fiat currencies. While it appears stable, all major currencies are losing purchasing power together. Recently, talk of yield curve control has quickly gone mainstream, signaling that central banks may soon cap long-term rates to contain debt costs. The U.S. looks set to follow this path, echoing past strategies to manage high debt. If that happens, it would echo what the U.S. did after World War II, when debt-to-GDP ratios were similar. Back then, the Fed and Treasury worked together to hold rates down, effectively inflating away the debt with cheaper dollars in the future. We could see something similar soon, especially if Fed leadership changes. This would likely require massive new quantitative easing, with central banks buying and monetizing their own debt in a move resembling modern monetary theory. Such a shift would push real interest rates deep into negative territory, and that's extraordinarily bullish for gold and other precious metals as fiat currencies are steadily devalued.
The deception of the dollar index, because it just compares the US dollar versus all this other equally worthless fiat, right? And so the dollar over time, you pull up a 30-year price chart of the dollar index and it's, you know, it's 100 and it goes up to 120 and down to 80 and it just stays basically the same. Well, that's because all the other fiat currencies are devaluing at the same rate. But I said, you know, expect more rate cuts than what people are thinking are coming. And furthermore, don't be surprised if by December, the December FOMC meeting, the Fed isn't openly talking about yield curve control. And I mean, I wrote that like on New Year's Eve last year. There were nobody talking about yield curve control. But now, all of a sudden, here in late August, early September, it's like, oh yeah, yield curve control is coming, like everybody was predicting this 8 months ago. Yield curve control is coming. You know, whether it's globally, if all these central banks have to do that to control the long end of their curve, right, and control their interest costs. But I think you're definitely being told and warned that it's coming here in the U.S. And I think that's all part of what's driving gold too, because that would be extremely bullish news for gold. You'd be holding real interest rates sharply negative. I mean, the US has done this before, which is why I wrote about it in my pod. I even put a link in there in that macrocast, because coming out of World War II, when we had similar debt to GDP ratios, that's what they did. They kind of combined the Fed and the Treasury together. They did yield curve control, essentially to pay off the debts of yesterday with the cheaper money of tomorrow, right? Get it under control, grow your way out of it, which is what Besant keeps talking about now. Well, anyway, if you want to take the time, to connect the dots, I mean, I think they're telling you that's what's coming as soon as next year, once Powell gets replaced and everything else. And so if that's the case, they're going to be trying to cap the long end. It's going to involve a lot of new quantitative easing measures, central banks buying their own debt, monetizing, almost like a modern monetary theory move. Again, all of this is extraordinarily bullish for the precious metals in terms of devaluing the existing fiat currency.
Both gold and silver are flashing signals of major shifts ahead, fueled by monetary policy, debt dynamics, and the growing disconnect between paper markets and physical supply. If central banks resort to yield curve control and deeper monetary easing, precious metals could enter a new era of explosive gains, marking a turning point for investors who have been patiently watching these markets build momentum. Do you think central banks will be forced into yield curve control sooner rather than later? If silver finally breaks above $50, will physical shortages in London expose the true limits of supply? Leave a comment below with your opinions. We would be delighted to hear from you. Please remember to subscribe for more material, and give this video a thumbs up if you found it useful. We appreciate you joining us on this adventure.
I think silver is getting ready to explode. We did get as high as 39.5, I think, while I was on vacation. So we've got a little bit of a psychological barrier up there, close to 40. But I think once we really clear $40 an ounce on silver, it's going to make a beeline for 50. And there probably will be rather, a little resistance around 50, because that's a massive double top going back to 1980 and 2011. But once we take that out, I think it's going to explode higher. And I think we'll be headed towards $100 an ounce is silver. Of course, gold's going to be $4,000 by then, but that still means you get a better bang for your buck.
Silver is emerging as a potentially explosive investment, driven by persistent supply deficits, 118 million ounces expected in 2025, and booming industrial demand. Inventories have fallen sharply, while recycling is failing to keep pace, setting the stage for a strong rally. Experts suggest that silver may soon transition from an overlooked asset to a monetary insurgent. Analysts consistently expect silver to reach $40 to $50 soon, with many citing a strong technical and fundamental setup. But this is often realized over longer horizons or under extreme conditions. Peter Schiff noted that gold slipped by about 0.6 to 0.7% this week, as easing geopolitical tensions and expectations of Fed policy weighed on safe haven demand. Silver, however, held steady with slight gains. UBS highlighted that while gold has remained range-bound, mining stocks are outperforming. The Gold Miners ETF is up 15% in 3 months and over 40% year-to-date. This shows growing investor confidence, with major players buying dips and driving mining shares higher. Because of this, he argues that mining stocks remain undervalued compared to the value of gold itself. ETFs like GDX and GDXJ outperform gold, despite recent profits and fundamentals looking strong, while valuations lag. UBS calls select miners undervalued. Mining ETFs have delivered double the gains of traditional gold ETFs in 2025 alone, confirming the leverage upside available. With gold clearing $3,000, mining equities are rallying more sharply. Long-term tailwinds and macro support suggest room to run for the sector. For additional information, view the video. Please subscribe and like the material if you enjoy it to receive the latest updates.
It was a pretty quiet week for the precious metals. Gold itself was actually down about 0.5%. I think it settled at around 3,336. Silver went the other direction. It actually rose a tad, up about 1/3%. And we closed the week above $38 an ounce. But from a technical perspective, I think the markets are set up for another explosive rally. And what really makes me optimistic now is the action that I am witnessing in the mining stocks. Because one of the problems with this rally for many, many years has been the failure of the mining stocks to confirm the continuous breakouts to new highs in gold and silver. And a lot of people who might have got into the market were discouraged by the lack of confirmation from the gold stocks because people think that gold stock investors, are sophisticated and forward-looking. Because when you're buying stock in a gold company, you're buying into an earnings stream. And so what's more important than the price of gold today is the price of gold tomorrow or, years from tomorrow. Because investors are looking into the future and they're discounting all that income into the present. And the problem was, as investors, particularly on Wall Street, watched the gold market rise, they really didn't understand why it was going up. And they just expected that, it's going to go down, that this is just a short-term thing. They found all sorts of reasons to attribute as to why the price of gold was going up. And so they just assumed that it was going to go down. And so they didn't want to buy gold stocks because if you think the price of gold is going to go down in the future, that means the mining company profits are going to go down, especially with costs going up. It gets more expensive to mine gold every year. So if the price of gold doesn't go up, it's hard to maintain your earnings. And if the price of gold goes down in the face of rising costs, that's a double whammy. And so the investors were staying away from gold stocks because they were very suspicious of the rally. Well, looking at the action this week, and even in recent weeks, I'm starting to see investors gaining some confidence in this bull market because I'm seeing days now where the price of gold is down quite a bit and these gold stocks are up. They used to get killed. Every time gold went down, they got destroyed. And then gold would make a new high, but the stocks wouldn't make a new high because they got beat up so much on a small dip. But now, instead of being dragged up by the metal, gold stocks are starting to lead with both the GDX and the GDXJ making 52-week highs on the week. In fact, the GDXJ, which made a new high after the GDX, made a new high this week and made a new high today on Friday. And both of those indexes are now up 65% on the year. That is a big move. Gold itself is only up about 25%. So finally, after years of lagging, they're now starting to outperform. And this is a bullish sign because now we've got confidence in this bull market. Now, some people might say, isn't that a contrarian indicator now that people are buying these stocks? Not really, because this is sophisticated money. The public is not involved. And it's not like this is a mania, a blowout stage where you go to the supermarket and the cashiers are talking about the penny gold stock that they just bought. The public is not involved in this market. This is more sophisticated money finally moving in. And the way I noticed that is a lot of these gold stocks, when they report their earnings, recently, every time they reported earnings, even if they beat numbers, they killed the stocks. And if they missed numbers, they destroyed the stocks. Well, a lot of companies have come out with earnings over the last couple of weeks. Some of them beat, some of them have missed, but even the misses were great earnings because, compared to what they earned the prior year. But what I've noticed is every time these stocks get sold off, almost reflexively on these earnings, they bounce right back It might not be the same day, maybe the next day, next 2 days, but they recover everything and move higher. So you have big money now that is buying the dips in these stocks. And this is just the beginning of a huge wave. In fact, that's why, if you remember back in April, I kind of angered some of my reps, my precious metal specialists over at Shift Gold, because I put out a special report from Europe Pacific Asset Management, and it was called The Best Way to Buy Gold. And I was saying, hey, don't buy gold right now. Buy gold stocks, because they were so cheap, and they're still cheap. Not as cheap as they were then, but still very cheap. I wasn't telling people not to buy gold. I was telling people to buy gold in the ground before it's dug up, because when you invest in a gold mining stock, you're buying the gold that's just still in the ground. When you go to Shift Gold, you're buying the gold that's already been mined and fabricated and made into a nice, pretty coin or a bar, right? And you're buying that. And what I was saying with that report is, you know what? Gold's over $3,000 an ounce, and look how cheap these mining stocks are. You got to buy these mining stocks right now. This is not the time to buy gold when these stocks are so cheap. And since I put out that report, the price of gold is only up by about 1%, but these gold stocks are up by more than 20%. Now, they were up quite a bit before I put out the report, but gold was going up a lot. And I thought it was ridiculous that gold made such a big move and the gold stocks were still so cheap. So now gold's kind of gone sideways for a few months, and the gold stocks have taken, the baton and run with it. And so I think this is, a marathon. I think we got a long way to go, but it's a very, very positive sign for the metals. And silver too. I mean, silver has been demonstrating some relative strength. So I'm not telling people now, hey, don't buy any gold and silver. Everybody should still own some physical gold and silver. But I also think that more aggressive investors should buy these gold mining stocks, because I think they're going to outperform now for many, many years. So if you really want to leverage up your portfolio, don't just own physical gold and silver.
The trend of countries moving away from the US dollar as a reserve currency is gathering pace in 2025. Central banks, especially in Southeast Asia and BRICS nations, are increasing their gold holdings and engaging in local currency trade settlements. In Q1 alone, central banks bought over 244 metric tons of gold, and gold ETFs attracted $30 billion in new investments. Bank of America reports that investors are heavily overweight emerging market equities, reaching levels not seen since February 2023. That's driven by a declining dollar, down nearly 10% this year. Simultaneously, investors are seeking refuge in gold mining companies. UBS and other analysts highlight that mining stocks are gaining traction as undervalued alternatives in the metals space. Experts are warning that aggressive political actions, such as pressure on the Federal Reserve and institutional interference, are eroding investor trust in U.S. assets. This erosion, combined with a massive fiscal deficit, could further erode the value of U.S. assets and encourage a shift away from the dollar. With dwindling confidence in treasuries and equities, gold has become a dominant haven. Citi analysts report that gold investment demand could exceed 110% of mine supply in the June quarter. With the dollar and treasuries now seeing reduced appeal, investors are reallocating into metals. Now, let's get back to the interview.
A long, long way to go, because the dollar has a long way to fall. I think this trend is going to go hyperbolic. I think when we go back to QE the next time and the Fed starts cutting rates, the economic data that's been coming out, technically the market sentiment looks good, but the economic fundamentals of stagflation are very strong for gold, right? Because we got last week, we got the disappointing jobs data, which was so bad. Not only did we miss estimates, but they revised down the prior 2 months by the most in 50 years. We barely create any jobs. And if you remember, if you're a regular listener of my podcast, not the Friday market wrap, which, again, I'm going to keep doing this market wrap, but I also do my podcasts. And on the Fridays where the May and June jobs numbers came out, I specifically said these numbers are going to be revised down because everybody was celebrating that the numbers came out better than expected. And I said, this is BS. They're not going to end up being better than expected. They're going to get revised down to weaker than expected. And I was 100% right. That's exactly what happened. In fact, the revisions were even bigger than what I was expecting. But these numbers may not even be right. They may revise them down again, although who knows, because Donald Trump got so mad that the numbers were so bad that he fired the head of the Bureau of Labor Statistics. He claimed the numbers were rigged to make him look bad. And now he's got a new guy, I think, but they may not even report the job numbers anymore for a while, right? Until they get it right. So maybe they need to fix it because I think Trump may be trying to hide the bad news from the public. See, Trump keeps talking about how the economy is booming. We have the hottest economy in the world. We don't. There is no economic boom. It's just a fantasy that Trump is trying to sell as reality. You know, if you look at the budget deficit for July, the month of July, it increased by 20% over last July. It's the second biggest July deficit in the history of the country. The only July where we ran a bigger deficit was 2021 when we had all the COVID stimulus. Well, we don't even have that anymore. And we got the benefit of all the tariff revenue, yet even with the tariffs, we still had the second biggest July deficit ever. Now, if we had a booming economy, we wouldn't have booming deficits. Booming economies reduce the deficits, right? Because the government doesn't have to spend as much on unemployment or welfare, and people are earning more money. They're paying more taxes. There's more jobs. There's more profits. And so the government is in better shape. The fact that the deficits are exploding is more proof that the economy is not. In fact, if you look at a lot of other economic data, the signs of stagflation are everywhere. In fact, this week, yesterday, we got the producer price index for July spiked up 0.9, way more than expected. Year over year number, much bigger than expected. I've been saying for a while, inflation has bottomed and is headed much higher. And now we're starting to see it in the data. Of course, we're going to see bigger and bigger prints in the months ahead as a lot of the tariffs really start to get factored in to these prices. And of course, businesses are going to end up raising prices by more than the tariffs. I mean, not only are they not going to absorb the tariffs, not only the consumer is going to pay more because as the prices go up, sales volumes go down. And so now businesses are forced to generate profits on lower sales. So how do they do that? Well, they need to increase their margins. So they have even higher prices and they try to make a profit with a smaller group of customers. But it's not just the tariffs and the need to, increase margins that are going to cause prices to go up. The dollar is very weak and is going to get a lot weaker. In fact, the dollar fell again this week. And even though we got a big bounce in the stock market, again, we had Newhoff, the phony reciprocal tariffs, was because he said the bond market was yippy. Well, I mean, it's still pretty yippy because it's about where it was back then. There hasn't been a recovery. And that's because there's real money in the bond market, right? Nobody is buying treasury bonds for, to speculate and get rich, right? It's not a meme stock. This is serious money that is selling U.S. treasuries. So the real money is getting out of dollars, getting out of treasuries, and getting into gold stocks, buying foreign stocks. That is what's going on. Foreign stocks are jamming. I have a foreign dividend payer fund that we also manage. I think it's up about 34, 35% on the year. The S&P, I don't even know if it's up 10%, 9%. I mean, foreign markets are, leaving the U.S. in the dust. It's like the U.S. stock market is standing still now because money is being sucked out of the U.S. economy and it's being brought back into the rest of the world. And that trend is going to continue as the U.S. economy slips deeper into stagflation. We're going to have a weakening economy. We're going to have strengthening inflation. The government might try to hide the numbers from the public, but the reality is going to show up in the bond market, in the foreign exchange market, in the precious metals market. And so my advice continues to be get out of dollars before the dollar loses any more of its purchasing power. Convert your fiat into real money, buy physical gold and silver?
The conditions for what may be one of the most explosive bull markets in decades are being created by the tightening supply of silver, soaring industrial demand, and growing investor attention. Gold has stabilized above $3,000. Mining stocks have also performed exceptionally well, suggesting that both miners and metals are well-positioned for long-term gains. Meanwhile, the global shift away from the dollar and toward tangible assets highlights why many people view gold and silver as essential stores of value in an unstable financial system, in addition to being considered investments. Will silver outperform gold in the upcoming bull cycle due to its distinct industrial role in solar and AI? Does this offer the most alluring entry point for aggressive investors today, given that mining stocks continue to be relatively cheap compared to metals? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.